Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
Live. Good to have you on, gents. We'll fly through. What are we going to cover today? We're going to cover a bit of who's benefiting from the property squeeze, a couple of other smaller companies.
I thought it was how do we benefit from
How do we benefit? Yeah, that's what we really want to know. That's a very good way.
It's all about us.
I'll hit it with a few bits of good news. Half of children given a skinny jab are no longer clinically obese. This is kind of what we've been tracking before, this new weight loss drugs. There's also something else curious about them, that people are reporting them reducing all types of addictions. So people on these weight loss drugs are finding themselves less addicted to everything that they're addicted to.
Drugs for drugs. Love it.
Drugs for drugs. But like someone's like, oh, I've stopped myself doing like splurge shopping or, like all these other things like social media or whatever. But the downside is you just replace it with this one new drug, which you then become dependent on. So
it's also a question. I mean, I don't know enough about it, but it's just sort of like, am I just disengaging with everything because I've just become more of I've been a bit zombified with all of that. There's sort of cause and effect, yes, but there's also sort of like the mode of like, I could probably cure a lot of your addictions by just putting you in a blind stupor for extended periods.
Coma. We've found that putting people in a coma.
Devil's in the detail. I'm just saying it feels with that.
No, I think that's fair.
To be fair, though, drug discovery has been incredible. I've been dependent on asthma medication my entire life, and it's allowed me to live a very full life compared to what the alternative would have been.
Oh, hell yeah.
So maybe this thing's great. Maybe it's not bad. I don't know.
Yeah. Yeah, that's fair. There's a new antibiotic discovered with artificial intelligence may defeat a dangerous superbug. And Elon Musk's brain implant firm Neuralink gets approval for human trial.
Wow, that's interesting.
Yeah, it's pretty interesting.
Some of the animal stuff there has been really impressive. Like,
the chimpanzee. The brain implant. Yeah.
It's really crazy too how it's got a bit like the cochlear implant where you make the wetware hardware interface kind of thing, but that's not it. Then it's sort of like the brain evolving or adapting to that new construct and growing and working collaboratively around that. That's what's really, really cool.
Yeah. There's something a long time ago where it was like they put a sensor, like a little chip on someone's tongue for people that don't have balance, basically. Like they don't have the inner ear balance. It's lacking. And it's just stimulating random parts of the tongue. But they found the brain just naturally wires that up to mean that you can then balance basically as a result. So just your tongue being like electronically stimulated is enough to like your brain just randomly associate, like figures out that that's connected with balancing basically. Like it just
so it's the stimulus is related to like a device that measures.
Yeah, so the device is like telling you when you're off balance and then stimulating and then like releasing a stimulus basically. And your brain just learns to associate that little electric stimulus with being balanced. Like it learns, so cool. Hey, when this happens, and so it just learns. Just amazing neuroplasticity of the brain.
Yeah, that's the word I was looking for.
Yep. Neuroplasticity.
Love it.
Plenty of AI stuff going on, which I think now the story is also just NVIDIA, which happened over the past week since our last episode. So
it's wild.
NVIDIA's rally was the biggest single day market cap gain for any stock in US stock market history. I think it was about $198 billion all told.
What's the PE now again?
That's a good question. I'd heard it was floating around 100 or so, but I could be wrong.
This is a company I think it's just shy of $1 trillion in market cap, trading on that kind of multiple. It just seems wild. I don't know enough about the business, but it's going to be hard. It's a high expectation to live up to.
Have Motley Fool released an AI special report yet?
I'm not sure. I have to check on that one. I actually don't think. Yeah, I mean, I'm not following NVIDIA closely, but I've heard some good stuff that it's like at least that first move, it wasn't actually as crazy as it might seem. That basically it was just such a huge jump in profitability, and it's a very profitable company. Talking about like people are talking about the sales multiple, and I just think you can it's irrelevant because it's at 70% profit margins and has close to a monopoly on this insane spending.
Pre-tax margins?
Yeah, that might be pre-tax.
Still either way, right?
Done.
Either way.
But yeah, so the idea is that NVIDIA is the company basically benefiting from this, everyone needing to suddenly get up to speed on AI fast. And so they all need the chips that NVIDIA builds, the GPUs, and everything else that goes with it. So they've just been leaders for a few years, and now they're just catching this wave. And there's other GPU providers like AMD, but they don't have the whole ecosystem around it as well. So yeah, it's going to be pretty interesting.
Time to take another look at BrainChip.
Oh my gosh. Okay. There's some slight differences. Revenues of hundreds of billions versus,
Details.
Yeah.
Stories.
But it's interesting because there's a lot of hypers, obviously, and a lot of the hype, I think a lot of the hype isn't investable. This is kind of like a picks and shovels thing to a degree, right? Like
yes.
They're funding the Capex. Everyone else who wants to suddenly has to throw money at having AI servers, and they're just in very short supply, basically. So yeah.
So you think they can live up to that? I mean, that is still some spectacular growth that you will need.
Yeah, I mean, I read a good take from someone who's been writing about semiconductors, a Substack. I think it's called Fabricated Knowledge, to give a shout out. But he basically went through it and was like, this isn't even crazy at all. If you just think the next couple of years, like that was before, like it's continued to rally since then. But yeah, he's just like, there's no way anyone's catching up to them. Everyone needs to buy from them. I guess you could say if something stopped all the AI excitement quickly, that could be an issue, but it does seem like one-way traffic at the moment. So yeah, it's potential. I think we have this bias when big stocks make big moves to instantly think that it's stupid, but I just think have to be careful not to shut our thinking down too much because sometimes they are actually justified.
Yeah, but oftentimes not. So that's the real dilemma. It's sort of like, do you have a good basis for that expectation of very substantial sustained?
You think of like David Gardner's thing, right? Like one of his tells that he likes to look for is everyone saying it's extremely overvalued in the media, which is like goes against a lot of what we think is like value investors. But I think what he's picking up on there is when that's happening, people stop looking at it properly and stop doing the math once people hear that enough. So that's my suspicion of what's going on.
That's interesting. I think what can be the challenge there is not just in identifying that, but holding through, because you generally see, even when you're right with that expectation, a lot of froth does tend to blow off along the way. So it's sort of like, 10 years time, you look back and go, yeah, that was actually a perfectly reasonable price. It's just that it dropped 50% like four times along the way, right?
100%. And that's part of his game.
Yeah.
David Gardner's kind of approach of not caring at all about that stuff.
Yeah, it's a superpower.
All right. What else is going on in the world? Claude, you had some a bit of news around housing that we were going to unpack.
Oh, that's right. Yeah. So the latest is, I think, very weak residential construction starts. And that was the news yesterday. And so I was kind of shocked this morning to see this little small cap, big River Industries, which does construction materials that some of which, gets used in residential construction. That's up 6%, but it was looking cheap. So it was already on my radar, but it's also weirdly perverse that, after this weak data, it's gone up. So I'm not.
It looks like it's pretty tiny volume. It's maybe $10,000 worth of shares or something.
Yeah, right. Okay, so it's probably just nothing. But yeah, still ignoring that little bump this morning as we're recording on Wednesday, 31st of May. But it has been a low PE stock, and you can see basically this is a troubled industry. There's a few flow throughs I thought we could talk about if construction is weak at the moment. And I guess, obviously that can mean we could see a weakening in employment. It could have ramifications for a company like Hipages, which obviously does that advertising tradie stuff, which has had a terrible downtrend, but maybe this means tradies will need to advertise more. And then, of course, it's just, as we were discussing off air, just the impact of weak housing construction into a situation where we're going to have quite high immigration.
Yeah, so just to unpack the numbers because you sent them through before. So residential building approvals in April were expected to be up 2% and they were down 8%. So for the year now down 24%. And I think that's one of the lowest building approvals. So it's basically like a forward-looking indicator on how many houses we're going to have coming online, basically, right? That's kind of the reason that it's interesting to follow. And yeah, we're just not building very many houses. At the same time, we have a lot of demand. Partly why we're not building many is because people are worried house prices are going to fall, I guess, is like a big part of it. And maybe
reasoning.
Interest rates are higher.
We don't have enough houses for everyone. Let's build some more. No, because then our value of our houses will go down. Okay. Is it just me, or is there
There's
craziness
a great
to
article
that?
actually in the AFR about what Auckland's done, which was in 2016, basically liberalized zoning laws dramatically. And I remember it at the time, although I wasn't living there, just kind of following how much of a storm it created. But suddenly freed up is like there's 3 zones. Yeah, so basically three separate zones. The most intensive allowed for 5 to 7 story buildings, which should be next to areas with good transport connection. The next for 3-story dwellings, and then least intensive 2-story with greater site coverage. So basically just making all of Auckland, or almost all of it, like excluding some heritage areas, you being able to do like low-rise developments, kind of like not big towers like you'd see in the middle of the CBD, but a few units up to a few stories high that just dramatically increase density. And yeah, so far it seems to have worked. So at least compared to the rest, like Auckland, New Zealand, like a lot of countries had this big boom during COVID, but since 2016, Auckland house prices are up 20% versus I think it was 70% for the rest of the country. So it seems to have potentially actually worked, and it's a pretty simple answer, which is just build more houses. Like
I keep coming back to that.
Prices to be too high, just have more of them.
Like I don't know how you get beyond that as a fun. I mean, it's the trouble is that there's a huge lag effect there, so it's not a solution that is going to move the dial quickly, but ultimately it's year 10
it's a free market solution as well, right? It's just open up, let developers develop, and they'll build property because there was a huge margin in it.
Yep.
A friend of mine who I think like invests in some property development companies and I guess paddock chopping kind of companies, or has done in the past, he was just saying to me the other day, look, if you give them the opportunity, I guarantee developers will find a way. And he said that, for financing reasons, he reckons there'll be more build to rent developments, just because that basically, and it hooks up with what we were saying earlier in the sense that if we're going to have strong rent inflation, maybe that's why banks are more willing to finance a build to rent operation, because they're like, yep, we think you're going to be able to rent it for this amount, so we'll finance it for that reason.
Yeah, it's interesting. And we talked before about like the impact of housing development on the property cycle. This is it's not a great thing for the general economy, because when you build a new house, it's a huge amount of spending. Then you need to refurbish it, blah, 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 or furnish it, I should say. And so just it's a weird stagflationy kind of thing, I think. That would be my read of it.
How so? Can you draw that out a bit more?
It basically, if we stop building new houses, that dampens economic activity. Or if we're
stop building. Sorry.
Yeah,
okay.
Basically building approvals being down just means less. That's quite a big driver of GDP growth. At the same time, it could push up rent inflation. That's where I could see it being a bit kind of stagflationary.
I'll give you some stats on that because I just read it. The RBA, Philip Lowe, fronted up to a bit of a grilling, and one of the comments he made, he expects rent inflation to reach close to 10% this year, which would be the highest rate since 1989. It's currently just shy of 5%, which is quite remarkable.
So this has me thinking, there's got to be an opportunity somewhere. I can't see the prices apartments are so high, it seems. How are we going to get on more supply without rent prices going up is basically what I'm seeing when I look at, the prices of apartments at the moment. It's so expensive to buy, and even then with interest rates up, it doesn't make sense for somebody to invest in them.
Well, as I've said to you guys before, when your net yield is less than half of what you get in a term deposit rate.
Exactly.
I don't even know how to finish that sentence if it's not obvious. Like it seems a little bit wild.
Back in the heydays of 2021, we heard a lot about, Tina, there is nothing else. But I feel like property also benefited from that. The money in the bank seems dead. Suddenly a 3% yield on your investment property didn't seem so bad, since the yield in the bank was, 0%.
I don't even think it had anything to do with yield, man. I thought the yield was actually, I'm going to structure to lose money, and I don't care because it's not about the yield. It traditionally is always about the yield. No, the last 20 years, it's just about the capital ka-ching-ching, it's that's all that matters, right? So people, this is the play, and it's not like a small subset of investors here. It's like very significant numbers actively plan to lose money and still do well because of substantial capital gain. Worked remarkably well, granted, but that's kind of the bet right now. If you're buying something with these really abysmal yields, you're implicitly betting that capital values will increase to a sufficient degree to offset all the loss and make it all worthwhile and beat what I could probably otherwise get in other relatively safe investments.
Yeah. So the read through you're thinking, Claude, is just a negative for anyone in housing construction, basically. Is that kind of what you were thinking?
I'm not sure about that, to be honest, because I'm just not like, I see demand is there, right? I feel like probably what happens is, I couldn't be sure about this, but I have a feeling that, quality of life for people and living standards is going to go down. Like inflation is making people poorer. You're going to have to spend more of your money on getting a roof over your head one way or another, whether you're paying off interest, etc. What does it benefit? It benefits people that have outright assets or some sort of increasing earning power that's attached to inflation. So that'd be a job where you have like bargaining power, basically. And at the end of the day, I feel like if we keep on, the approach we're taking to bringing in immigrants to work, which I'm all for, that they need to be housed somewhere. And so the demand will be there. And as long as there's not too weighed down by debt, I think a lot of companies in construction will be okay. But of course, there'll be more blow-ups, of course, when you have high interest rates and debt. That's what it can cause for its own reasons.
I'll just mention something. I know I mentioned it to you guys just off air before, but I think pretty undeniable there'll be a bit of a tailwind in terms of rents, and Lowe's just sort of made that comment. My pushback comes at I don't know at what point this is, but I believe there are real affordability issues at a certain stage where it's just like, oh, well, I'll just pass that on to the tenants. You already see, and in fact, our recent experience with moving home and looking at various rentals was that there was a threshold below which there was 30 people at the door and above which there was 2 people. And it wasn't because, well, what was the difference? It just there were hard physical limits against what I can actually sort of spend. And so I feel as though there's probably more room to grow, and people will rightly try and charge as much as they can. But it is not necessarily a safe assumption that I can just increase as much as I like without having any impact on sort of demand, and just finding enough people in the market who can support that. The other side of that is as well, and I don't know what the figures are, so I'd appreciate anyone who's got any insight here, is that what is the wealth, how financially privileged are the immigrants that we're welcoming? Are we got a lot of fruit pickers and nurse assistants and et cetera, which we desperately need, and all those kinds of things? I don't know if they've got the kind of buying power that's going to meaningfully move the dial on all of this kind of thing. Or are all immigrants like surgeons and investment bankers? So do you know what I mean? Like there comes a point where these things start to matter. And it's different. It's different with buying, because buying is credit based. It's if there's more money around and more favorable lending conditions, prices will go up because people can afford to borrow more and spend more. So it's much easier. There is something that is qualitatively different when it comes to renting.
And who benefits in terms of ASX listed companies? I guess it's real estate REITs, basically. I'm trying to think who wins from like higher rentals. Anything?
Well, that's interesting too, isn't it? Because I think most REITs are more commercial, industrial. I mean, how many REITs are focused on the purely residential side? I can't think of. I mean, I'm sure there are. It's a space I never really look at. But yeah, it's interesting.
Maybe there's more. Maybe it's time to have a look at the troubled Doc McGrath, that real estate agent. I remember from recollection they had a rental role, so they might actually get a bit of built-in growth just from rents going up.
It's not going to be an investment I make anytime soon. I'm too biased. There's no way you can. You can lay out the perfect thesis, and I'm like,
investing is no real estate agent.
It would actually be interesting to see. You know how like when you own something, you end up like kind of rooting for it a lot more.
The endowment effect.
I'd love to see what would happen if you did. We should buy some for Andrew and just see what happens. Like,
I want him to buy $500 worth of shares and do the Stephen Mayne route and like go to the AGM and just like cut loose.
Let loose.
They're like, dude, why are you here?
What about things like John's Lyng Group and those kinds of
If I was in the mood for just sort of like random trading, JLG is kind of interesting because I think it's a bit of a hot stock in that space. I'm not sure.
So JLG, they basically do repair work, right, for insurance companies.
Yes.
And then they do it after. And the other one is the catastrophe stuff. So basically like flood and whatever else, the big stuff's at work. Yeah. So what would the idea be, like tying JLG into that? I guess just frees up a bit more. I guess they're going to be pretty dependent, you'd think, either way, right?
I just come back to this idea that came out of the old Warren Buffett letters, which I reviewed for the inflationary period in the past. And at the end of that period, what he was saying was like the winners is stuff that is capital light. And I know it doesn't feel like that
during
now.
Inflationary periods.
Yeah, exactly. Yeah. So it's like basically, because the problem with the capital intensity during inflationary periods is even if you're growing and you are growing profitably, then the actual cash, the business is cash hungry. It's sucking the cash in ahead of that profit constantly. Now, that doesn't mean the business is bad, full stop. If the returns on that capital investment are good, then, why not? But at the end of a longer period of inflation, Buffett's impression was, I think I've got I've got it on my website somewhere, but essentially what it came down to is pricing power and capital intensity. That's what you really want. You want the ability for a company just to put up the price just because kind of thing.
I think so I definitely think that's true. Also, Buffett said it, so we can probably say he's pretty smart. One interesting wrinkle at the moment, interested your guys' take, is just the shortage of Capex. There's multiple things that are kind of driving this huge wave of potential capital spending, being, separating away from China, so friendshoring, decarbonization, etc. Some of those things are actually really capital intensive, and you'd think if we're going to do a huge amount of Capex, it could be the case that you actually have companies, like they'll be getting tailwinds, basically. Like the company that goes out and does all that Capex are the one that governments will be calling on. So it's kind of like an interesting wrinkle at the moment, where some of what's driving the inflation is this need for this huge wave of Capex, which could potentially benefit those capital intensive companies.
Yeah, exactly. And so they can have a good cyclical run. And if the fund manager of the fund I invest in is going to capture some of that, then great.
I think what's interesting about that is you can have a reasonably dire economic outlook and still think that true, because there will be sort of a lot of political pressure for stimulatory measures. What do you do when it comes time to stimulate? You build infrastructure, right? Big nation building projects. It's so easy for a politician to kind of sell. It creates jobs. It does all these things, So I agree, Matt. I think that's a decent argument.
Yeah, I guess it would be. It's just kind of like we've grown up during a period where capital light is like all of our mantras. I think we all have like capital light in there. It's just kind of an interesting thing to flip on its head and think a lot of the capital intensive stuff could actually have quite a tailwind, even though, as you say, Claude, it's not ideal from an inflationary perspective.
I think that's right, and I think we've already sort of seen that for in last year kind of or so. The energy was the place to hide out, or energy or resources adjacent stuff was the place to be. And I think that may continue to be the case for a while. Who knows how long these super cycles take. And quite frankly, I think that the idea is that you buy for a good price the capital light stuff with pricing power. The problem is that that has become such a mantra, and all of those stocks have got bidded up like a lot. So it's like perhaps now we're just in a different age where that got valued more and it got priced in more. So actually where the mispricing was is in cyclical stocks that weren't having the best time, and the market had forgotten about their potential to have a great time when things go well. So perhaps that is exactly the play. And that obviously just puts on its head the old wisdom that I quoted. But, you're dead right. You've got to think about, well, that was the end of the last inflationary period that he said that. It may be completely different this time.
I think it's worth factoring in certain exceptions to the rule as well. We started this pod talking about NVIDIA, which is pretty capital intensive. And yet,
super capital. That's actually what I was thinking about as well. Like NVIDIA is one of those things. It's just a different type of capex. But
yes. So it's not, and then there are other, so it's really easy to put a shopping list together of, well, what do I want for a business? Well, I want something that can grow without much reinvestment. It's very capital light. I like high margins, please, recurring revenue, whatever. And you can list it all out. But then you have other companies like Data3 actually might be a good example. Like it just runs on the tiniest, the super ultra razor thin margins. And you think, why would I ever be interested in a company that's rides so close to the line like that? But you can deframe it and look at it in a different way and say, well, actually, that's the moat. That's the edge. No one, they're doing it at absolutely the minimum cost. It's like no one can rationally compete at those kinds of levels. And yet, despite that sort of what you might consider as a negative in and of itself, ultra thin margins, what they do? They 20 cents per share in earnings off $14.16 in sales per share last year, right? But that 20-cent earnings per share was 10 cents in 2017. It was 5 cents in 2014. Data is another interesting example of that kind of thing. There are these, I don't know what my point is here, other than sort of saying there are these really unusual exceptions to the rule where on paper you would think these are sort of negative things, and yet something is clearly going on which has driven substantial shareholder wealth creation over long periods of time.
Yeah, and I think to tie it back, like what Claude was saying originally, you want to find those spots in the industry for some of these tailwinds. Although you can invest in the capital intensive one, there's often this capital light one that captures a lot of the value, and that's kind of where we ideally like to hunt. And I'm sure there'll still be some of those for all of this demand tailwind as well. But yeah, and doing the capital intensive side, it is much harder than people realize. Like you look at what's going on with like lithium prices crashing recently, a lot of those miners.
Who saw that coming? That was really unexpected.
But it's like It's easy to get too focused on like one part of the equation, if that makes sense.
Yeah. Yep.
And it ignores
Exactly.
that capitalism is this like amazing, complex, adaptive system with all these different forces that are trying to stop things going too crazy. Like the system doesn't want really high lithium prices, basically. Every other aspect of the system pushes against that because it's a big distort, makes things expensive. And so you have adaptation, basically. And another one
Preach, brother.
But you had uranium price. A lot of uranium miners fell recently. It's another one where it's like you can have this thesis, like as I have become very pro nuclear power, for instance, but it's very different to seeing that exercised in the world. Yeah, and I think for some of these, like I see that for a lot of the battery metals, where people get like to see a one-way bet from electrification, but kind of miss. You can substitute out certain metals, or you can redesign to not use as much, or you can like you build a lot more mines basically. If there's nothing, all these things get adapted to, and in surprising ways that it's hard to foresee when you're just
100%. You're such a good point. First level versus second level kind of thinking. I mean, I could almost frame that up too. I'm shoot from the hip here, so excuse any bad thinking, but we're talking about building booms, construction shortfalls, and potential there. So it'd be easy, I think, to kind of go, there's potential to take an investment in this space. It's probably also worth remembering that a lot of companies in this industry get wiped out very quickly. There's usually a pretty big reliance on debt. Construction costs, materials can spike unexpectedly. Vendors can't pay. The subcontractors like 1,000 layers deep. Everything from cost blowouts to overrun. That's the story of the industry, and we see lots and lots of companies going to the wall in that space. It doesn't mean that the sector as a whole, on average, has done pretty well over time and there's good tailwinds. But it's just something else to keep in mind that it does tend to be a pretty cut and thrust kind of sector, and things can quickly unwind.
It's a huge issue. I think you're right. So like you look at, particularly as Claude mentioned, like a few of the construction companies, right? Like a contractor construction company. If they're doing a big fixed price contract, basically like growth is probably the best predictor of failure, because like these companies are all bidding for the same contract, right? So a friend of mine described it as like the moment that you win a contract is the scariest moment of the contractor's life.
We've got to deliver on this now.
Yeah, we've got to actually do this thing. And so you've locked in a fixed price, you're on the hook for all the risk. And like, let's say it works, and then you do it again, and you do it again. And eventually from the outside, you'll just see this company that's growing every year. And it's like, man, this is such a great operator. It's so much better than all of its competitors. Growth. And then one day it's just like an ASX announcement where it's like, oh, we have an issue, we need to write this down. But then it's just like the floor falls away. The whole business can go bankrupt basically, effectively instantaneously from the outside perspective.
Let's look at Lendlease, like the biggest listed construction company in Australia, an absolute behemoth. Its share price has done nothing over 10 years. Its earnings have been all over the place. So you don't have to predict the future to sort of know that, just looking at historical evidence of the companies that you would think have pretty big advantages in this kind of space. And there's been no shortage of activity over that time frame. It's been pretty crappy for shareholders, right? Maybe I'm cherry picking. It was just the biggest one I thought of and punched it into my screen here. And it's like, what an absolute shit show.
Yeah, you guys have definitely put me off like construction companies. Although I feel like, there's always things that are on the adjacent.
I'm not trying to, Claude. I'm really just devil's advocating here in the sense that there's other things to consider.
A place that I've been more willing to play, and you guys have even talked me into this view more by ragging on contractors. But what about, they're kind of contractor, but what about companies that are different kinds of distribution networks? So I think you mentioned Dicker Data earlier. That's one example of a capital intensive one, but there are others. You could argue that the transport stocks like Lindsay, they're in a way, they're a distribution network, right? They just distribute anything, and they're different ownership models and stuff like that. On the website, we've got articles about, stinky old DGL, the chemicals distributor. That is, relatively cheap. I mean, that's relatively cheap now, right? Because it kind of surely it just did become a bit sociologically toxic, and is it too cheap?
You're right. I think there's something to that. I think that they should have a bit more motiness to them and should benefit from that. I guess that then just comes down to which macro view are you thinking? Are you thinking like inflation higher for longer, or in a recession all these businesses get pretty hit because they, at least temporarily, because they're so tied to economic activity?
Yeah, exactly. But talking myself into these the kind of distributors again, like sometimes they're quite low PE multiples as well. So perhaps, I don't know, you're just sort of reflecting that risk, right? But it's like they seem to be pricing in like there's going to be a recession, basically. So if we listen to those stocks,
I think that's fair.
I tell you another example of sort of that first level thinking that's that's not worked out well. There's Incitec Pivot, so fertilizer and explosives. Now, if you want some big macro super cycle themes to get behind, I would imagine that fertilizer is really way up there in terms of what the world needs. And if we're going to dig all these holes to pull out all these metals and rare earths, we probably need a lot of explosives as well. Well, that's kind of been true for a while. And share price has gone, I mean, again, it's just been a really subpar performance. And there's factors at play that are there, but again, it's not what you would expect. And it's easy to sort of be right in a broad sense, but be very wrong on a stock specific sense, because, execution and the operational effectiveness can easily overcome otherwise very favorable conditions.
Yeah, I think you're 100% right. I think that's a great example, because you look back to the start of 2022 when Russia's just invaded, right?
Right.
And food prices are soaring. It is so many reasons that you should have a huge surge in their business. That, like that's all. And now the world's adapted. Like food prices come back down, fertilizer prices even come back down, which again is kind of really still surprising to me given how high energy prices have been. So yeah, it just shows how much the system adapts. And I think we don't want to get too, that's like, you can think about the macro stuff to be aware of risks, but you don't want to drive your whole decision from it.
That's the point. You much better said. Thank you.
Yeah, cool. All right. Claude, you had another topic about luck. Was there anything else you wanted to chat about?
Yeah, that was a good general discussion one. I wanted to ask you guys, I know we're going to probably have 3 different takes on this completely, but I thought we could share, how do you think about luck in investing in what you do? How do you sort of think about the role of luck, and how do you try to, I guess, interact with it?
I think about it a lot, man. I think about it so much. I think it's the biggest danger for an investor is to have a period of good luck, because you start to mistake it for skill, which emboldens you to take more risk, which sort of can just lead to dangerous outcomes. And I'll put myself out there as an example of how I think I've really benefited from luck. So actually, I mentioned to you guys off air, I'm coming up to the 10-year anniversary from when I set up a trust to house all my share market investments 10 years ago. And the track record's been really good. I'm really happy with it, right? But a lot of the stocks that did the heavy lifting, well, the businesses performed. I kind of felt that was obviously a big part of the thesis, that these businesses would do well. I'll be honest with you, I had no expectation, and certainly the investment thesis wasn't couched in the fact that, also price to sales will go from 3 to 20, right? Like that was not part of, I mean, you take it when the market gives you that kind of thing. And yes, I could have played quote unquote that much better and sold too soon in a lot of cases, et cetera, et cetera. But that was luck, right? I mean, I'll take credit for some of the gains there, but no, I can't. I can't look you in the eye and honestly say, oh yeah, no, that was always my thesis, that the market's just going to get, super excited about these particular kind of companies over this period. And now we've seen the reversal of that in a lot of these sort of growth/tech stocks. And yeah, I think it would be wrong to assume those things kind of revert back to where they were. And if they did, it'll be luck, back to your original point. So I don't know, am I right to attribute a big chunk of that to luck? I mean, I'll take the other argument if you want to blame it, give me credit, but I'm pretty sure it was luck, right?
I'll riff off that. I think that even just as investors, everything we do is mostly luck, and that's especially true if we're just doing long-term investing. I feel like there's different ways to think of it, but I think of us as, it's like you're a pebble in a river or whatever, but you can swim a little bit, so you can try and get to different areas. So I think that if you make a bunch of bets in the kind of area that you think is where some companies are going to get lucky, and I think then you can sort of basically put yourself in an area where then you still need some luck to come your way, basically.
Yeah.
And you can be, you can just miss it. You can buy 10 stocks and it was the 11th stock that was the lucky one. And, the studies have all shown that with index returns, that's kind of how indexing works. Is like you're just sort of making sure you buy everything, so you have at least some really good ones.
And most of the return comes from a really small subset of stocks.
Exactly. So I feel like for long-term investing, you need to be lucky. And I have been lucky in the past. I've been less lucky recently, but that's because less luck has come to the areas where I guess I've traditionally invested. And I think for most of the time, the kind of areas where I invest is where you can get really lucky. smaller companies can move a lot more. They can move a lot more to the downside as well as the upside. But overall, things mostly go up. I think that a big part of investing is trying to basically and also this holds for life, it's about taking risks where you've got your sort of sail up to get lucky. You're taking risks that don't need to work out. So basically nothing can take you out of the game, or you get like many, many shots at goal. Basically, you don't make any risk where you're like, okay, this is the one that needs to work, or I'm out of luck, because you might not get luck then. So I feel like part of what investing is trying to move to where the luck is. And sometimes I've done that better than others, but I feel like in a philosophical sense, the most absolutely overwhelming impact on our life always is luck for me.
You're just kidding yourself if you don't think it plays. Like, we can debate the degree.
I think what you can control is you can accept your luck. The point that I wanted to make is that we can make sure we're open to luck by giving a story long enough to play out, for example, and also by not betting too big on one thing so that you can just keep playing and stay in it. And also it's influenced by how well you can pick the areas that are going to be lucky. And I think it's doable. Somebody who bought an NVIDIA last week might have just sort of picked, I can tell this hype is taking off. But somebody else might have actually just held NVIDIA for 5 years up and down, and they've got their luck is coming right now.
Yeah, I think that's a great framing for it. I guess so the high level way I think about it is probabilistically, or probabilities basically, which is exactly what you're talking about. I think luck is often inferred to mean like good luck or bad luck, and I guess I'm just thinking of it as like a probability distribution or a cloud of probabilities that we're thinking about is how I like to frame it, because I just find it maybe a bit more neutral as like a language, because it doesn't really matter whether it's good for you or bad for you, or the distribution doesn't care, like the outcome doesn't care whether it's good or bad for you. And so I think that what you're talking about, so a few threads of what you mentioned, is investing is inherently a game with a wide range of probabilities, and it's a probabilistic game. So there's different types of games, and there's different like ratio between what you might call like skill versus chance or skill versus luck in different games. So like poker is a game which has a lot of luck in it, but a lot of skill, and because it's like a knowable distribution in advance, the distribution isn't changing, there's only a certain number of cards in the deck. But in the same way, if you play a lot of poker, you realize like you can play each hand perfectly and still lose that hand, right? Because it's probabilistic. And that's kind of like a good framing to start with investing. But the probability distributions that you're playing in, you get to choose. This is kind of like Warren Buffett's waiting for a fat pitch. I think there's no called strikes in investing, is his comment. And what that's talking about really is waiting for probability distributions that are in your favor, or at least appealing to you as a long-term investor.
Yes.
I'm so glad you said that. I just want to put the exclamation on that. That's such a good point.
Yeah, cool. And I think that it swings, and that distribution, it's an outcome as well, right? It's not just whether it's positive or negative. So we talked about Soros the other day, who would only have a win rate of, I think it was 20 to 30% from memory. I was quoting him couple of weeks ago. But when he did win, they were such home run wins. And you could say venture capital is kind of like that. Soros is probably a bit different. Soros' thing different to venture capital is also he didn't lose much on those losses. So he had a very low win rate, but didn't lose too much on the ones he lost, and then they made his home runs. Whereas as a long-term investor, maybe I think often we talked about like 60%, like trying to have a 60% hit rate. So in that case, you're winning more often, but probably with fewer home runs in the distribution. Or at least that's the kind of standard. If you think of like Buffett long-term investing is like having a lot more winners, having few, like if you look at his distribution of returns over time, Buffett's thing is all about eliminating risk. Is like rule number one is don't lose money. So he's trying to move his distribution where there's a lot of positive outcomes. There's probably a couple of home runs in there, like Geico, that end up just the way that these distributions go, but still like relative wise, most of his things are just doing quite well, not hitting the lights out, but he's also not having things that go really badly. And so, you have this choice of what your distributions you play in. And I think other things you can do, like I've thought about it a bit. I had a half drafted article I'd started writing about it, because I think there's a lot of things in life you can do to shift your your like distribution that you're playing in. And it applies to investing as well. So like fishing in the right ponds, I think, is choosing what distribution you're in.
But just on the ponds metaphor, I think it's a good it's a good point. And I think also something that you try to do, and you do well, I think, is, thinking about which pond is the right one to fish in today. And that ties back to your other point about, you can wait until the probabilities are looking better for that, particular space. I'm really looking forward to the time that comes again when actually money is starting to flow back into, small cap growth stocks, because, they can be so fun when the market's right for them. But at the moment, it's been a long time since, that has been getting flows, that space, and it's been going elsewhere. And it's useful to think about, there's a different season for each pond, perhaps.
You definitely make your own luck too, to some extent, and that's that probabilistic way of thinking. I know a lot of people have criticisms for looking through the lens of things like expected value calculations and Kelly criterion. I don't know if you guys do much of that with position sizing or deciding, whether or not to take the investment. The criticism usually stems from, well, you don't actually know the odds, right? And you don't get multiple throws of the dice. So it works really well for things like card and dice and roulette wheels, but it doesn't work so well for shares. When I say, well, what is the upside here versus the downside? I can guess. And if I'm wrong, maybe I don't get to replicate that exact setup, 100 times for the average to sort of shine through. But I do think it helps in your thinking in terms of looking at the spectrum of outcomes. And to your earlier point, Claude, just sort of saying, well, if I get it wrong, there's sort of this downside. If I get it right, there is this kind of upside. And if I can reasonably guesstimate those kinds of things, I'm not going to set things to 8 decimal places against what these formulas throw out. But I do find it pretty instructive. Let me give you an example, right? Let's say you've looked over a 20-year history as a seasoned trader investor, and you figured out that 80%, you sort of have a 50-50 win rate, but when you win, you gain 80%, and when you lose 50%. Now, for the sake of argument, let's say you were pretty confident that those stats would more or less hold true over the next little period of time. How do you play that? I mean, what do you do? And let's just be really stupid and just say, I can guarantee that's the stats that you're going to be playing with. Well, the temptation is just like, I'm just going to keep doing that because it's just, I'm going to come out well ahead. The average is actually really nice under those stats. The mode and the medium are really awful and in fact negative. It's called the just one more fallacy, right? Because what actually happens is you have these outliers where you just sort of hit heads 8 times in a row, which just gives you these massive outcomes, which drag everything up. But things like the EV, Kelly criterion thinking will at least make you think, well, actually, no, there is a position sizing element to all of this. And I can actually happily operate in an environment where the stats I've given or stats that happen to be far worse can still make a great amount of sense. Anyway, I'm crapping on at this point. Am I speaking nonsense?
I think you're right. But what you're mentioning is part of the challenge, right? So so basically I think all these things apply, like Kelly criterion, expected value, apply perfectly in theory. And the challenge is that we operate in a domain which is a complex adaptive domain. And as you say, where you don't get infinite rolls of the dice, where the distributions are actually changing. It's not like a chess game. And you have really long feedback loops as well. So you don't know what the shape of the distribution is, and you won't even know until many years later what it was when you made that decision. If you even really know, like it takes a lot of work to even know that.
Exactly.
So it's just a really hard game to build up expertise in. And frankly, I think that's why it's so fascinating. It's like one of the hardest games that there is as a result. But I think that jives with what you were saying as well. I just
think you can be wrong on a whole bunch of things, but still have a process that overall makes sense. As long as there's some basis in reality to what you think the odds are likely to be going forward. And it's that thing I always crap on about. It's just enough asymmetry there. It's sort of, you said it before, Claude. I only need a small handful to do really well. And if I'm only sort of going for investment opportunities where, if I get this right, I might get, a little bit more than market average over the next 10 years. Well, it's just not going to gel with the wider strategy unless you've got pretty high hit rates, right?
I don't know if I do it the right way, but I guess the way that I invest and think about things, I do always make room for sort of heuristics, that kind of subjective judgment. And so to me, the idea of like whether something feels lucky, it's not a complete joke to me. It's like sometimes I feel like that idea of that something if something to me feels lucky, then it might be actually a good sign that, it's a changing narrative. It's kind of a way that I kind of recognize something. And, for example, in some ways, that's why I've had so much on the sidelines for so long, because like just the whole space that is my favorite space to invest in, where I've found the luckiest wins in the past, has just been, everywhere there has been having a tough time for all at the same time, essentially. So that to me made it feel kind of unlucky. And I'm basically at this point, the biggest enemy for me is just, do I have the patience to just keep waiting? Because it still haven't feel that kind of bull market sense coming down that much to small cap tech. And the interesting thing for me is this stuff with this silly AI hype. That is the first thing where I'm starting to see good luck hit some, tech stocks. NVIDIA went up and a bunch of tech stocks in Australia went up for no, necessary apparent sensible reason. Like, I think I've been joking with you guys about some of them during the week. And, we saw Hansen, which is like a fairly sleepy software company that came from $4.60 to $5. We saw, Altium got a bid. It come up about 10% in a few days. We already had, perhaps for different reasons, some of them, but, TNE, Technology One, that is, WiseTech, like all of this, like basically a lot of tech just seemed to get a bit like, it's random luck, right? It's like a bubble's going on somewhere else and stuff's picking up. But that sort of zeitgeist, maybe that does start flowing down into small caps at some point soon, or maybe it doesn't. I don't know if I'm feeling lucky yet, but I can see in those tech stocks, like if you're holding one of those tech stocks and it randomly goes up 10% in 2 days because of NVIDIA, like that feels like the luck coming back to the sector a little bit.
Claude, can I just ask, so when you just dig into something you said, when you said that luck is kind of important, do you mean that you use your intuition about how lucky things are feeling to help decide? Like, if you're feeling luckier, like you kind of are more likely to deploy kind of thing?
I know I'm kind of just taking the semantically different approach to it. I completely agree with all the probabilistic thinking you're talking about. I think that's a really good, rational way to go about thinking about it. But yeah, there is also, I guess, a space for instinct and intuition and how that can inform you. But it's also based on observational data, right? Like I just told you about 5 tech stocks that all simultaneously move up 5%, 10% in the same couple of days. Like obviously, like there's that factor kind of starting to wake up a little bit there.
I don't think there's anything unusual, or weird or crazy or anything of what you're saying, because it's kind of like, as you say, what I'm describing is like a rational approach, and what you're describing is more of an intuitive one. And you look at like, it's kind of like your sociological thing or more of a trading mindset. Like Druckenmiller talks about this as well. Like when he's feeling like he's hitting the ball, he swings hard and tries to hit home runs. When he's not feeling it, then he just hits singles. And that feeling is kind of what you're referring to, I think, is probably the same type of thing.
And I feel like sometimes I don't listen to that feeling and I let the rational one make the decision more. And I'm not always sure that has worked out for me. And it's annoying for me because now I can't really act quickly. And it's like, if I was just purely just trading and investing off my own bat, I could buy a bunch of tech stocks basically because I'm like, I feel this wave coming. But now I'm not in a situation where I can do that. So I feel like those kind of impulses that sometimes your intuition can guide you well. And it's not out of ignorance either, because, I know all these companies well. It's not like I'm buying some ticker. I don't know what it does. Like, these are companies I like. I'm pretty sure in the long term, most of them will, some I like more than others. The point is, I wouldn't be buying like the one I hate. I'd be buying the one that I already kind of wanted to buy at anyway. Mm-hmm. And I feel like that's kind of, that for me is the easiest and funnest way to invest. And it, I'm not feeling it. I'm not getting to do it lately, but what I can do is, write more actively about it when I have those kind of intangible, that like the instinctual things. I think I've got to get better at articulating that in a way that doesn't make me seem like I'm just acting on a whim. It's like there's logic behind it, but like what it comes down to is like, hey guys, everything's moving up. Like now might be the time to like, jump on that one you've been eyeing off, then you're waiting for 20 cents cheaper, that kind of thing. And yeah, I guess I'm opening up for discussion, like how legitimate is this kind of way of thinking about it.
I think, yeah. I think that there is something legitimate to it, but it's the challenge is you have to have good interoperception to know that what you're feeling isn't just FOMO. You have to separate out. This is something like an intuition I've built up from years of doing this versus I'm caught up in the AI hype wave. And that's just something only you can answer for yourself. I think it's really hard to see from the outside, probably. I don't know if I can.
Exactly.
But that's basically it. That's the challenge of it, right? Like separating out good intuition from bad.
Sorry, one more very quick thing. I think a good example of luck, because I only just posted something on Strawman this morning about it. One of our members, Bear, actually, he's just a fantastic member. He made the point, and he put some stuff from Wesfarmers Strategy Investor Day there. So Wesfarmers just knocked it out of the park, over the long term for shareholders. One of the figures that caught my eye was that the CAGR has been 17% per annum for shareholders on a total return basis, so dividends reinvested over the last 5 years. So it's smashed the market, this big conglomerate, giant sort of behemoth thing. It's like 17% per annum. Are you kidding me? And I haven't looked at it for ages. I thought, wow, I guess they've had a pretty good run. Actually, when you look at either the earnings per share or the dividends per share, I think it's pretty good metrics for a company like that to sort of look at. I mean, they've grown at less than 3% per annum over that period. I mean, square that circle for me. Well, I mean, I'll do it for you. It's the PE went from 16 to 26. Now, comes back to the point I was sort of making before. I don't want to take anything away from Wesfarmers shareholders because they've done exceptionally well. But can you bank on, 60% increase expansion of the PE going forward? Was that part of your core investment thesis at the time that would happen? Is this a consequence of what I'm not getting here is the fact that actually, well, it's been pretty low single digit growth for the last 5 years. The next 5 years are going to be fantastic. Well, the consensus guidance is 6%. So I did a bit of maths. I was like, all right, let's say Wesfarmers just like knocks it out of the park. Compound annual growth rate average 12% per annum each and every year for the next 3 years. Well, the PE goes from 26 back to 18. You've got no capital gain under that environment. Now, I think those are the things that for me, I will take credit when a business performs in more or less directionally in line with my expectations, because I felt as though that was the usually for me, that's the foundation of the investment thesis. Big changes in sentiment and multiple contraction and expansion, I think even over a multi-year period. I don't know how anything that is described as anything other than luck, unless perhaps you had some really cogent and accurate forecast on the structural change in interest rates or something, perhaps.
Yeah, that's a good
I don't know what the point is there, but
no, I think it's a great
luck,
point.
right?
I do think there can be some of the uplift can be skill if you saw like you think this thing should be worth a lot more inherently, but I think it's I think that just looking at earnings versus multiple, if you were wanting to cleanly break the two apart,
yes,
what's in your control versus not in your control maybe, and then that's kind of like more of a luck factor.
Again, you say it much more succinctly and better. Thank you.
You can do definitely both, but yeah, but you also just need luck for them to work out. Sometimes there'll be a huge uplift in multiple. Like it's pretty lucky when
it's great. It's great when it happens,
and it just shows the power of the sociology and the humans behind the market as well. But that's the thing is, it's like there's so many stocks now that have like a PE of like 70 or something, and it wasn't just that. It was just there's this whole, those kind of stocks, they became much more in vogue. Like I remember back in the day, a whole bunch of the ones that now have 50, 60 times earnings, they were like, 15, 20. It was like a whole sector of software stocks. So
yeah.
Lucky for us that we let's invest in software companies and the whole.
Yeah, that was my original point. I'm trying to be real with myself, and I just think that there was just a huge amount of luck there. And I think the way to approach it is that you don't ever want to be dependent too much on luck, but recognize that luck will always be a factor, and that if you have bad luck, there's less downside than when there's good luck, and then there's upside. So you position yourself to benefit from luck when it happens, and if bad luck happens, at least you've got a good fundamental underpinning to sort of help support things.
Yeah, and keep dry powder until you're seeing like the probabilities look great.
Yep, 100%.
Like it. That's a good way to wrap. If anyone has any other thoughts on luck or home builders or who's going to benefit from all this stuff, anyone, hit us up on Twitter at BabyGiantsPod. Until next time, thank you very much for listening.
Thanks, everyone.
Have a nice day.